Hello, everybody. My name is Stephane Prigent, the CEO of Katch Investment Group. Welcome to this webinar dedicated to the KEREP fund. So KEREP stands for Katch European Real Estate Partners Fund. On the call, we have today Youssef Sbai. Youssef is the portfolio manager for KEREP. He has more than 10 years of experience in real estate investments. And his skills are in value-add investment, especially. He worked at different asset managers company, and he was involved in the acquisition of more than 2 billion of real estate properties in Spain, France, and Germany. Just a quick reminder on Katch. So the Katch Investment Group, it's an asset manager focused on private debt. Our head office is in London, where we're regulated by the FCA. We manage a bit more than 1 billion. We have more than 62 employees in the group, with offices in Sao Paulo, Panama, Singapore, and London. And we are involved in 4 strategies, mainly litigation finance in the UK, direct lending in Europe, real estate bridging in the UK, and finally factoring in Brazil. We have a tilt towards private debt, but we also, when we see opportunities, we don't hesitate to offer them to our investors as well. So this is what we do with this new fund that offer exposure to real estate residential in Europe. The reason we saw these opportunities is that the banks in Europe, they do not lend easily anymore to real estate developers, especially outside of the big cities. So we offer exposure to medium-sized cities, and we have a tilt towards high-end, and Youssef is going to talk a little bit more about that, because we believe that this segment is a lot more resilient to potential economic crisis. So I'm going to let Youssef give you a quick introduction to this new fund. And then we're going to start a Q&A session with the audience. So do not hesitate to post your questions that I will repeat them for Youssef, for him to answer. Youssef, over to you.
Thank you, Stephane, for the introduction. Hi, everyone, and thanks for joining the KEREP webinar. So, as Stephane mentioned, we seized a new opportunity that we decided to launch last year, as the KEREP fund has been launched in July 2023 with an investment strategy based initially in 3 pillars, or what we can say 3 reasons or an exception reason for which we launched this fund. So first one is the increase of special real estate opportunities that we start seeing 2022, but also last year and this year. Our wish to leverage the expertise that our team has for real estate equity in Europe. And the last one is to combine an agile strategy between equity and debt for high potential assets. In terms of investment focus for KEREP, we are focusing in 3 sub-strategies, which are refurbishment, reconversion, and elevation of assets. And in terms of market targets, so we focus on France, Spain, and UK. And I can, in the next slide, touch a little bit more on this, on the sub-markets in each country. Here, I will just quickly touch base on the fund's KPIs, and mainly, and can start with the target performance. So here we're targeting 20% IRR per annum, a multiple of 2 after 4 years. As also some of you know, the fund is a closed-ended fund, so it's very different from our open-ended funds related to the debt strategies, with a duration of 4 years. So we're targeting a life cycle of 4 years, plus potentially a 2 years extension, the time for us to divest from all the positions that we will have by then in the fund. The NAV calculation will be semi-annual, and will be published, obviously, as we said, every 6 months, and the valuation will be conducted by external valuers. So we can touch base as well a little bit more in detail about this point later. And finally, in terms of fees, here we are charging 2% management fee plus a performance fee of 20% at the exit, obviously, when the life cycle of the fund is expired. To move again here to the target market. So as I mentioned, France, Spain, UK. In France, we are targeting prime markets like Paris, Lyon, Marseille, but also in this prime market, we will divide them in sub-markets. So for example, Paris, we won't be targeting all the areas, all the arrondissements, but some specific arrondissements where we see an opportunity to create value. So for example, in Paris, it will be the 7th, the 6th, the 3rd arrondissement. And then we have a focus on niche markets. So niche markets is really markets that are uncorrelated with the current economic environment, like, for example, Courchevel, Megève, Saint-Tropez in France, but also in Spain, we are targeting markets like Malaga or Marbella, which are niche market, without obviously forgetting the prime markets like Madrid and Barcelona. And finally, the UK. UK is a strong market, despite what we've seen recently in terms of real estate prices decreasing. We start seeing bounce back. But again, when it comes to prime areas, very high-end areas, the market is very resilient, strong, and we can see that the demand is still there, and the prices are extremely resilient in this type of areas. Here, yeah, we can move to the next point where Stephane, I will hand over to you.
Yeah, so we're gonna start a series of questions for Youssef. So if you have any, please post it in using the Q&A button on the screen. The first question is probably the most important one for you, Youssef, is why do you think investors should invest in KEREP?
Yeah, thanks, Stephane. It's obviously a very good question. I think there are many reasons, but I will highlight 4 of them. The first one is that we are focusing on niche and high-end markets, as we mentioned previously. And these are markets where we focus on high-end residential projects located in highly demanded areas and liquid areas which are uncorrelated, as I said, to the current market environment, but also benefiting from strong appetite from cash buyers. So if we take again example of Courchevel or Marbella, we've seen during the last couple of years a huge proportion of cash buyers coming to these markets and looking to invest their capital into real estate. The second point is our capacity to partner with local investors who are expert in their markets and strategy. So these investors are acting as co-investors in KEREP project, but also local project managers and partners sharing the same goals and incentives with KEREP. So this is a very important. Then the third one is the origination capabilities that we have in France, in Spain, obviously also in the UK, through off-market channels, allowing us to source very active opportunities. And this is for us the key in such a value-add strategy, because we need to get access to off-market deal that will allow us to get a significant or attractive discount in the price at the acquisition to allow us to get a high return at the exit. And finally, the fourth point is the fund's life cycle that we mentioned earlier. It's 4 years. It's a very short life cycle compared to other value-add funds that usually target a 7 to 10 years life cycle, and then their exposure to the market risk, like for example, a cycle side, the cycle of the market, so the market could bounce back, is higher. So here we really focus on a short-term life cycle of the fund, but also which is important to be able to reach this short life cycle of the fund, we need to focus on projects that have a life cycle between 18 to 24 months that will allow us as well to recycle the cash during the life cycle of the fund and obviously exit soon enough before expiration or the deadline of the life cycle of the fund.
Thank you, Youssef. So you mentioned that we focus on the high-end side of the market. Could you explain the benefits of this positioning, please?
Of course. Here, I think we have 5 key reasons why we should focus on high-end and niche markets. So the first one is something that came quite a few times since we started the webinar, is the correlation with the current economic situation. It's very important because, again, these are markets that are resilient. It's bubble market, but in a positive way, because they're not impacted by the external environment. They really focus on themselves and basically on the attractiveness that they have towards high net worth individuals and cash buyers. In these markets, what we've noticed as well is that the demand is exceeding the offer, and which create a shortage in terms of product, and obviously helps to maintain the price or even increase it. A high proportion of foreign cash buyers in this market, as I mentioned. Liquidity is proven in this market as well. Position asset usually sell in short period of time, and very often what we've seen during the last few months, most of the time they sell off market. And obviously, as I mentioned before, it's the resilience of this market in terms of prices, and even we can notice an increase in prices per square meter in some market. If we take typically Courchevel market, we've seen over the last couple of years market prices going up. If we take also in terms of prime markets, but again in some specific area, if we take Madrid, we've noticed that in the Salamanca area, which is a very central area of Madrid, where there is a huge demand from foreign buyers, the prices have a tendency now to go up. And overall in Madrid in 2022, the prices went up by almost 8%, when in other capitals in Europe, we've seen actually a decrease in the price per square meter.
Yeah, so we have a question from Jerome actually that relates to what you just said. I mean, he's saying that we have seen some projects going down 30% in value, actually in Paris, and he's asking about our take on the evolution of real estate project values at the moment.
Yeah, I mean, of course, there are projects that are going down, especially when, for example, investors were focusing on office space. So the office space is not doing very well. We've seen a huge discount in terms of values as the yields went up. They were extremely low. They went up. There is a lack of also an increase in terms of vacancy, which impacts the value of this asset. We've seen also some residential projects, especially on the new products going down, but this is more on the suburbs of Paris, because the prices were already too high and before and after the COVID. But if we analyze well the area and we invest in the right area, the right product, the prices are still either resilient or going up. So typically investing in the 6th arrondissement, the 3rd arrondissement, the 7th arrondissement, but also buying at the right price. We need to enter the investment at a discounted price. So if we pay market or over price, then we expose ourselves to a risk of downturn and then a decrease in our value. But by acquiring low, injecting capex, creating value, and selling, the risk is quite limited.
Okay, very clear. We have another question on our origination process and strategy. Could you comment on that, Youssef?
Yes, I can give a quick heads up here on the origination process and strategy, of course. So here, obviously, as a polling and understood, so here is our sourcing strategy, is really to originate as much as possible of market deals, which by experience through the different investments I conducted in the past, they are the most profitable. And they allow the fund to acquire the asset at a great discount. So this is, to me, this is the key point. We can have a very strong project management team. We can have a very strong construction team, very a strong marketing team. If we don't acquire the right project or the right asset at a discounted price, we still are going to have a massive risk of downturn. And the second thing is why we believe that we are strong to build and launch the strategy is our sourcing channel and network, as it's based on in-house contact, but also on our local partners. So as I mentioned before, we have local partners who are co-investors. They usually have a strong network in place, and that has been built over a decade. And this has allowed us basically to, on each sub-market or each niche market, to get straight to the off-market deals that will allow us to make great profits and behaviors.
Next question is, during our last webinar that we organized in November, you talk about the difficulty to achieve the targeted return without using leverage. Can you remind us how you managed to secure financing in the current lending environment, and how the situation changed last time we organized the webinar in November?
Okay, yeah, sure. I mean, last time in November, we discussed the fact that we were working closely with banks and debt funds. So it's still the case. We're still working very closely with banks, debt funds in France, in Spain, also a little bit in the UK, who are supporting us by financing our project. We have, I will give an example of one of the deals right after that we recently closed, so that we closed last month. And for this one, it's a deal in Marbella. We managed to close a financing at 65% LTC. And it was a choice from us to keep it a little bit low, because we could stretch it a little bit further and get it to 72% LTV, or LTC. So we chose to keep it a little bit low to avoid having a high cost of debt. And again, in terms of market, so the financing here, market improved significantly since last November, when we had the last webinar. We now see banks financing again and easier, especially in an established market like Paris or Madrid. For example, Madrid, the Spanish banks are focusing on 85% of their loan are done now in Madrid or Madrid suburb. They're really keen to finance any project that makes sense, obviously, to them in Madrid. And what we've seen as well is that the rates are starting to drop slowly, but it's enough to start boosting back the market. And this is something we are seeing right now, for example, in the UK, and maybe especially in London, where the rates were extremely high. Now they're dropping, and buyers are coming back. They're really keen to acquire real estate assets again.
Okay. Again, I mean, if you have any question, please post them on this Q&A button. The next question is, if you could provide some example of recently closed deals, please.
Yeah, of course. I will, as I mentioned, we just closed recently a deal in Marbella, so I will present this one. It's very in line with our strategy. The deal consists on the acquisition of a unique front golf property. We're planning to refurbish it, to enhance it, and to upgrade it into a luxury property with unique features. As this house is a front golf, it has a completely clear view on the golf, but it has also amazing view on La Concha, which is the famous mountain in Marbella, but also sea views as well. So we combine the three views plus a very unique location and a property that will be extremely modern with a sauna, indoor spa, indoor pool, a gym, a cinema, a 360 degrees rooftop with a pergola over 160 square meters of rooftop. It's amazing features that we planning to here to sell at completion at 9 million, which will allow us to reach our net target IRR here of 47%, which is an equity multiple of 1.47. Here as well, what is important to mention, it's a very short project duration because there is no licensing. It's an existing house. We just need to pay fee to activate the refurbishment license and start the day after the acquisition. So our start planning is really a 6 to 8 month time period, 8 months for the refurbishment through thanks to our experience also partner and co-investor in Spain, and then 4 months marketing and sell period, which has been already proved by our also local partners in the marketing and sale area, managed to sell very similar houses in a very short time period, and very often actually off market. I will also touch base on the pipeline. I've chosen here to share a few deals from our strong pipeline. The first one consists on the investment in residential development in London. Here we're talking about a mixed-use project of 121 apartment units mixed with office space and retail space. Here we're talking about a ticket of almost 6 million pound, 40 month duration maximum, which is the very conservative part. There is already financing in place of 67 million with a GDV here of 111 million. Here, net target IRR is 20%. It's way lower than obviously the Marbella deal. What we are talking about, it's a bit longer, but as you can see, the equity multiple is higher. But we are talking about a more secure deal in a very established market. We're in a very established area in the London borough where there is a massive shortage of housing and a huge demand from potential buyers. I will give here another example in Madrid, Salamanca. So I spoke about Madrid, Salamanca, where there is a massive as well demand from foreign buyers and investors. And again, here the deal involved the acquisition and refurbishment of a single unit in central Madrid, where we buy it from an old lady who wants to sell it, and we managed to get it at almost 35% discount compared to the market value. We inject capital, so capex to refurbish and upgrade this unit, and then we plan to sell it at around 7.7 million euros. So here net target IRR is 30% short-term project again. And the last one, so we can also look at an example of these in France. Here it's typically the acquisition and the refurbishment, and as the extension, as we're planning to 2 rooms, as well as the upgrade of property in Saint-Tropez, in south of France, in a very exclusive area, gated area, where we're planning again to acquire the property with our local partner, as I mentioned, upgrade it, extend it, and then sell it to a foreign or local buyer. Here, net target IRR is 34% and 1.31 equity multiple. Yeah, that's it regarding. Obviously, we have a stronger pipeline in place that we are working on, and obviously increasing every day. But I'll manage to choose here to share with you 3 typical deals that we would do either in France, Spain, or UK.
Thank you, Youssef. I mean, you mentioned a lot of cities here, so we can see that the portfolio is well diversified. Maybe the last question is, can you comment on how the NAV is going to be of the fund is going to be calculated?
Yes, thanks, Stephane, for the reminder. Indeed, we spoke about it at the beginning of the presentation about the NAV, that it's calculated semi-annually, and the variation will be driven by the valuation of each asset. So as you know, when we acquire the property, we have what we call the as-is value or the residual value. And then the further we deploy CapEx and we improve the property or refurbish it or extend it, the value of this property goes up until we reach completion and then get to the gross development value. So this is how we plan to do it. We have valuations in place of valuers with whom we work, so top tier one valuers, usually with the RICS accreditations, and they provide you with the Red Book valuation. Every 6 months, they go on site, they conduct their market analysis, and they provide us with as-is value, which basically, as I said, is the value that is meant to change as the further you spend CapEx and you get closer to the completion date. And then the gross development value to confirm and comfort us on our exit strategy and exit pricing to make sure that in 6 months the exit and the project itself price, for example, is exactly the same, didn't go down, or maybe sometimes it can go up, so we can readjust our projections in terms of IRR.
Thank you very much, Youssef. So I don't see more questions. So maybe to conclude, I mean, we're offering exposure to a closed-ended fund that will invest in residential properties in the UK, France, and Spain. It's a value add transactions focus on luxury houses. We successfully managed to raise more than $25 million, so it's a bit more than expected. The subscription period is going to end at the end of May, so in 50 days. So that's the last opportunity to invest. We have a very strong pipeline of deals, and we're seeing a lot of opportunities, and we believe that we will be able to deploy all the cash that we have in the fund in the next 4 or 5 months. Because of this success and because we continue to believe in more opportunities in the next 2 years, we're potentially planning to launch the second version of that fund next year in January 2025. So thank you very much again for attention, and we'll see you next month for another webinar. Thank you very much.
Thank you everyone for joining. Speak soon, and don't hesitate to reach out to us if you have any additional questions.